Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 6th, 2025. And it was an interesting week, a lot of economic data. And I'm titling this video, Liquidity Keeps Markets Buoyant as Labor Data Softens. And I think that is a good summation of where we're at. And I'll dig into the economic data and the charts here in just a minute. But before I get started, I am host of Invest Talk, Justin Klein, and I want to remind you to subscribe to our channel here on YouTube, as well as our podcast, Invest Talk, and make sure to hit that notification bell so every time I post one of these videos, you can get it. Now let's take a look at the market this week. You see a lot of green. This is the heat map, right, of the S&P. A lot of the Mag 7 positive, pretty much all of them, except for Tesla. Obviously, the spat with Elon and President Trump that kneecapped Tesla's performance. But outside of that, you really only saw some weakness in those consumer staples. Rates rising, that makes sense. A little more risk on sentiment in the markets. So this color, this look makes sense for how the market interpreted the economic data. Now, I interpret it a little bit differently, more neutral as opposed to a little bullish. But I'll give you some background from liquidity perspective on why the market does remain buoyant. So that was the market this week. And let's dig into the economic numbers because it was a busy week. On Monday, we had ISM manufacturing PMI that came in little slight deceleration, still below 50. So shrinkage, but nothing dire here. Now, remember, the manufacturing part of our economy is low teens as a percentage of the total economy. So it matters, but it's not nearly as important as the ISM services, which we'll talk about in a second. That came out on Wednesday. Now on Tuesday we had durable goods, excluding defense. I always like to do that because that's what public money is spending on. But what's the private sector? What you can see here, it's a pretty clear picture. This was all front running, right? Front running the tariffs and trying to get ahead of that, ordering a bunch of new products to refrigerators and cars and couches and things like that. Remember, durable goods are anything that lasts over a year. And so it was front running, and then April we had the tariffs and people stopped ordering. So, if you take those 2 months together, still kind of flatline. So still not a really good picture of what it will look like going forward. But something to certainly be watching. And remember, durable goods is a good indicator of how confident people are because these are big ticket items. It's not your $10-20 product at the store. So these are typically thousands of dollars. So we'll be watching that. But you can clearly see that picture, front running of the tariffs and then just stopping in April, just especially with all the uncertainty, right? We also had JOLTS data, job openings. That was on Tuesday. So that was the first piece of labor data this week. Got a lot of labor data, and that was a bit positive. It's still in a downtrend over the past couple of 3 years, but it's not breaking to new lows. We were at September of last year. We were at 7.1 million. We threatened that in March to 7.2. And if we got a deceleration again, we might have broken that, but we had that little acceleration. So these are how many jobs that are posted. It's not my favorite labor statistic because, especially in the world of online jobs and online work from home, there can be jobs that are posted in multiple regions, and it's the same job. So I don't think it's the best data series, but it's of note. Wednesday we had the ADP employment change. I think this is always a better indicator of the labor market because this is the ADP. This is a private. This is nothing government. Government can't fudge this, right? They can't manipulate it in any way. It's the ADP numbers. These the ADP and Paychecks. They're kind of the two largest uh, payroll companies out there, and so they have a clear view of what is happening in the labor market with their customers. And so the labor market did decelerate 37,000 jobs to the lowest level since way back here, actually below that. Yeah, 1 year, 3 year. We're at a 3 year low on this number. Let's see, yeah, 10,000 jobs, March 2023. So you're talking over 2 years. There we go. So very interesting to see that. We also had ISM services PMI. I talked about that. We had manufacturing services. This is vast majority of the economy. So this is far more important than manufacturing side. It's decelerated to 49.9, so slightly below 50, which indicates shrinkage. And not the lowest of the last 3 years, but we're dipping back into those low territories. So certainly of note, and it was really driven by this, which was the new order index. Okay, that plummeted to the lowest level since December of 2022. So I thought that was the really the weakest point of the of the economic data this week. A lot of it was mixed, but that was pretty clear. That was fairly negative. And this is the prices paid part of that series, which is accelerating to, let's see, it was just probably the highest level since, yeah, where are we? Going back to late 2022, when inflation was very high. And so is this an indication that inflation is about to reaccelerate? This whole ISM services series was very stagflationary, right? New orders down, overall series. The employment index was slightly ticked up. That was a positive, but with the prices rising, that was very stagflationary. Then on Thursday, we had the unemployment insurance. Now this is a weekly series. You get a lot of data here regularly, and this moved to a new high. This was kind of staying within range around this 220, 230 range. Now we're up closer to 250, the highest level since October of last year, and we're getting up into those higher regions that we've been in the last 3 years. Not a breakout, but certainly something to watch. Now, the continuing claims, I always say this is more important. It did tick down a little bit, so that was a bit of a positive, but still kind of above that 1.9 million level. If this ever gets to 2 million, that's a clear sign the labor market's breaking to the downside, and it builds on itself. There's a reflexive nature to this. So once again, it was another not terrible data point, but not good. Now, the non-farm payrolls on Friday, that was the big number. Headline was 139,000, better than expected. But the previous months were downgraded by about 95,000 jobs compared to their previous estimate. So net net, you're talking somewhere similar to what ADP said, which is around 40,000 net jobs. I don't think that's a great print overall. And you can see it's still kind of hanging around this low 100,000 mark for the past really all year. So you're not getting these good months of 200,000 plus like you were getting a lot of last year in 2023. I think the headline that the labor market is okay. I just don't see that in the numbers here. I see a labor market that is clearly weakening. And I said this last week. I talked to some of the local business owners that I'm in a group with, and we meet every month and we talk about what's happening in our businesses and help each other out and things like that. And they're very overall they're very I would say not necessarily negative, but uh, very wishy-washy on what they feel about their businesses going forward, and with a lot of uncertainty, and that means they're just not really hiring. And so I think that's obviously that's anecdotal, but kind of corroborates the numbers that we see here. Now, why is the market kind of holding up? I think it's the liquidity. So we talked about bank credit. Banks are still lending. Talked about this series, how important this is to see banks continuing to lend, and how this you want this in an uptrend year over year, and that's telling you that banks are creating dollars. Banks, commercial banks are the main way that dollars are created in the system. In a fractional reserve banking system, that's how it works. And so if they are lending, that is good for liquidity. Okay, and you can see this big drop, right? It peaked in 2022. Really peaked in yeah, early 2022, flattened out, and then fell all the way through into early 2023. So Um, I think this is an important series. And then also this, which is the Treasury General Account weekly average. What you can see here is we've hit the debt ceiling, right? And so what they're trying to pass a new bill, raise the debt ceiling. It's in the Senate. There's obviously a lot of infighting with what's happening with Trump and Elon. But in the meanwhile, what is the Treasury doing? They are winding down. They're drawing down the Treasury General Account, which is the checkbook of the Treasury, from 600 billion in April to now 378 billion. It's over 200 billion dollars that's being pushed into the system without a take back of borrowing coming out of the system. Remember, it's a give and a take. When the Treasury spends into the economy, that's positive for liquidity. When they go and borrow money, that's them taking liquidity out of the market or the economy and putting it into the Treasury General Account. And so, if they're not issuing a ton of new securities because of the debt ceiling, that is pulling that means that money is just flowing out of the Treasury General Account and into the economy. So I think that's a big reason why the equity markets are generally holding up. So just a heads up there. We do have a Fed meeting coming up here in 11 days. So not this week, but the week after. They're not doing anything. It's a 97% chance they will keep rates where they're at. And then you have four more more decisions between now and year end. And that pretty much closes out the first half of the year, which means no rate cuts in the first half of the year. But you go out to December, you do have two rate cuts kind of priced in here. But what you can see is it's actually leaning a little bit more that it'll only be one rate cut. So 1 to 2 is now kind of what is priced in. So I think the market's a bit offsides. And let's dig into the charts here. So here's a weekly chart of the S&P, and I'll pull up a couple other, I think, important charts. And what you can see here is the MACD. It's below the zero line, excuse me. It's threatening to break above it, but what you can see if we go back to this downtrend, you had that rollover, the initial rollover, and that brought the MACD line back here. This is 2022 into negative territory. We got the bounce. It was a much shorter bounce than this one for about 3 weeks in March of 2022. And then the market rolled over into the fall. Not to say it's going to happen again, but you're getting a similar pattern right now. Excuse me. So that is kind of the setup here. Let's go to the daily chart. I've talked about this zone, and we're threatening the high end of this zone right around. I kind of mark 6,000 as that marker between 6,000 and 5,700, and we closed right on it. So the market closed at 6,036 at the close today. Closed on Friday, excuse me. So you're pretty much there, and it'll be very interesting to see if this gets. Let's see if I can expand this. Can I expand this? No, that's not what I wanted. No. Let's cut that. There we go. That's for close enough. Clean this up here. These things can get messy. All right. So yeah, I mean, this is still the range. We're at the top of the range. We're a bit overbought, but once again, the longer you stay here, it definitely gives the power for this to move higher. Don't want to rule that out. But what's the catalyst here? It's again, the labor market, I think, is weakening in a bit. You're having some social unrest here in California over some of the ICE raids. So, some domestic issues, obviously the Elon thing and Trump. So, I don't think that's going to be real big market movers, but what is the true catalyst to really break us out of this range? I don't really see it quite yet. So, still on the watch for that. I think you still have to be mildly bullish, but not a place that you want to add positions in size right now. But if you can get a couple more weeks where you get above the 6,000 level and you start to repair this obviously damage in the chart that's happened, I think things could move in a better direction. But I'm still not convinced that we're going to get that in earnest. You can see that here with the NYSE, you know, still lower highs, lower lows. This is the broader index, S&P's 500 names, is 2,500 names, and really this still has not reached that level where you had that big reversal back in late February. So I'm watching for that to break as well. Let's take a look at the gold market. That is another indicator. You're getting gold kind of weakening a bit, and you know that can be a leading indicator. Let's see if this wants to pull up. Sometimes my charts are looking finicky. So yeah, here's GDX, definitely having some weakness, some divergence here. I think we're entering more of a consolidation period for gold and silver. So definitely on the lookout for that, right? Lower highs, lower lows. You have to call it for what it is. MACD is negative. So, you know, is this telling you liquidity is ebbing? I think that certainly could be the case here. So um, I'm now starting to get neutral on gold, at least in the short term. You know, silver did have a great week, which is interesting. So that kind of broke out a little more bullish on silver than gold. Um, I'm still not really grasping the catalyst here, but the charts are the charts, and you have to call a spade, and you have to judge it for that. So definitely getting a bit more bullish on silver than I am gold at the moment. The big positive here, I think, for the markets is the VIX. We did break and close below that March low here. And that was a positive. So low liquidity. If we get back into this 15 range and kind of stay there, hey, you're in a good situation. It means that the market's in a light volume float and no real problems at the moment. So that's certainly of note. The move index, let's see, that's 89. Really no issues with the treasury market, despite what's happening with the budget situation. You know, they are issuing on the short end, so you know you're not getting a huge rise in interest rates. You know, the TLT has kind of held that 85 range. They said that was like the you know, big support, a big break, right? We did break that temporarily, and now we're back above it. So you know, the treasury market isn't really breaking at, once again, at the moment. Same with the 10-year; it's not breaking to new lows and breaking rates breaking out to the upside. So something I'm noticing, and you know, those are kind of some positives that you have to notice. The dollar's also getting a little traction here. That could be, you know, taking a little of the wind out of the sails of the gold market. Something of note here. You know, you can see the MACD is still below the zero line, still in a downtrend. So it might just be a choppy period for the dollar. That's kind of what I expect. Probably not a huge rally in my mind. The yen, kind of same thing, right? Kind of slowing down. You're seeing a MACD divergence. So this is kind of the inverse of what you're seeing with the dollar. So could you see yen weakening? And there's a lot of correlation between gold prices and the yen. Something I'm noticing as well. So you know, nothing is really giving me a clear picture here, both from the economic front, from the charts perspective. There still needs to be a lot of repair done for you to feel comfortable with what is happening in the technical picture. But I do want to go pivot over to the uh, this is something I'm watching, which is private equity. I've said this before. This is where the bad lending happened, and I look at here. There's three main players that are public. You have Blackstone, which you can see is big rollover. Really started in the fall. I thought that's of note, right? Really just past the election, right? And you've rallied, but this is still in a downtrend. This is weak, right? Rallied, strong pullback, and just consolidating. This is bearish. Okay, and then you look at Apollo. That's the second one. Kind of similar chart pattern there, and then KKR. All look very similar, right? Below the 100-day moving averages, they bounce. They're not really getting a lot of traction. So this is telling me a lot about what is happening in the private credit markets. And here is JAA, which is the CLO market. So you know, with the tariff situation, with higher interest rates, this is a recipe for problems in that space. And I think this is where you could see things unravel in a certain way. And I'm on watch for that, and what signals that is giving me. When it comes from a sector perspective, the banks are holding up. Here's KBE that's doing okay. Utilities, that has been probably the weakest part of the market recently. You can see rough week this week on the higher rates. So money is, this is more of the safer part of the market. So the fact that it's weakening a little bit is of note. Uh, and I'll be watching that. But, overall, this is a market that's still kind of a wait and see because of the economic backdrop, because of the issues I'm seeing in private credit, and the fact that there's these liquidity dynamics due to bank credit, and especially the Treasury General account being wound down, that I think are very short term, that maybe could be masking a lot of the issues underneath the surface. So um, currently on the market, medium term, I remain neutral. I'm not bearish. I'm not bullish. I'm very similar to where I was coming into the year. We're gonna have a choppy year, sell-offs, rallies, and that's what we've had. We're coming into the close of the first half of the year, and that's what really we've had. And I don't think the second half is going to be much different, right? You have a kind of a chaotic situation with the budget, with this administration, and there could be new tariff news, both positive and negative, and I think you're starting to get used to that. The whole taco thing, and whether Trump is going to continue to back up. Is that going to inflame him to be tougher on the tariffs front? I think potentially, if you know kind of his temperament. So neutral. Neutral is how you have to be very selective. It's a stock picker's market. You want to be focused on names that remain trending in a positive direction, that have secular tailwinds behind them, and will continue to benefit from those longer term tailwinds in a uncertain economic environment. So that's my message for this week. I hope this was enlightening. Appreciate you all tuning in, and reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.